Hello, Dave.
Hello.
Nice to have you on our YouTube channel.
Great to
How
be
did
here.
you find your way into value investing?
Value investing, I think I was just lucky. I came into the business about 38 years ago.
That's a long time.
Yeah, people did not like stocks, they did not like bonds, so everything was a value then. I worked for a firm that ran its own money, so they didn't really care about value or growth, but it was instilled in me that that's what investing was. You figured out what a company was worth and you paid less than it was worth. And later on, when the consultants came in, they said, your value. I'm like, works for me. Certainly, it does seem to be in my DNA. I don't like overpaying.
That's good. So, how did your style of value investing changed in this 38 years?
Well, I think the basics probably have not changed, but I think over time, I hopefully have evolved in terms of how we look at enterprise value and how we define that and looking at different metrics. It used to be fairly simple. Let's discount dividends or discount earnings later. But as things went on, it became clear that maybe asset-heavy businesses should be looked at under asset ratios like book value or replacement value, whereas asset-light businesses should be looked more on the cash flow and cash flow ability. So a lot of different mini metrics and also industry-specific metrics.
What would you tell a young value investor when he comes into the industry or starts investing for it himself? What would be the first 3 steps to do?
3 steps. Good question. Yeah, I think now would be an interesting time to come in because it's been 12 years, I think, since value's done well. Our kind of value's been better, but it's been pretty much 6 tough years even for our style. So if somebody believes in value now, I think they've got a lot of potential as a value investor. But I think people should read all the great value investors, read the great growth investors, invest their own money and see how they feel, see how they're wired. For me, I like value because if you've done your homework and you've bought something below what it's worth and it drops more, it's easier to have conviction and increase the position. Whereas if you've bought something on momentum or you bought things on speculation or you've bought things based on a scenario of a very optimistic future, it's hard to keep your nerve when life disappoints you. So value works for me, but certainly it's less exciting at cocktail parties.
How would you describe your strategy?
Our strategy, I would view as value is a prerequisite. It's not even a philosophy. Our strategy is to spend all our time appraising businesses, deciding what we want to pay for it, and looking for a discount, and adjusting the discount we want based on where the company's located, geopolitical risk, balance sheet risk, management risk, obsolescence risk, and then buying things when they're below that. Now, buying good assets at less than their worth usually requires that you do something unpopular. Usually it's because people don't like the industry or they don't like the country or they don't like the stock movement or you name it. So often it means being quite contrary, which we're comfortable with.
In what kind of unloved sectors are you currently fishing?
Well, now like 1999, there are things that are loved and things that are hated. And the things that are loved are very, very expensive, which makes it all the more exciting that other things are cheap, very attractive. In 99, it was old economy, bricks and mortar, small cap. Now people tend to not like emerging markets. They tend to not like cyclicality. They tend to not like hard assets and that sort of thing, which has led us to a lot of emerging markets. We're getting growth at a cheap price, and a lot of tangible assets that are selling way below what we view they could be replaced at.
What kind of industries, for instance?
Our biggest holding right now is gold miners. We like gold for a lot of reasons, but even if one didn't like gold, over the last decade, gold's gone from about 1,300 to about 1,300, but the companies that own gold underground have gone down 85%. So you get gold at a massive discount if you're willing to buy it on the stock market. And so that's our biggest holding. We see some downside protection because they're trading below liquidation value. And we see massive optionality if gold goes to what we think is a more appropriate price.
What else do you like?
We similarly like uranium. Uranium being a commodity that people don't like because it's radioactive, but they do like because there's no carbon footprint, there's no CO2 greenhouse gas, there's also no pollution. So it's got strengths and weaknesses like a lot of things. People got very excited by it a couple dozen years ago. The price ran up to $137 a pound. It then fell to 18. Now it's around 24. At these prices, nobody's opening mines. People are shutting mines down. Japan's reopening their nuclear reactors. You've had the U.S. government stop selling uranium. You've had the Russian government stop selling uranium. You've had Cameco shut down the best mine in history. You've had investment funds start up just to own uranium. People can argue what the right price for uranium is, whether it's $40 or $60 or $80, but 24 we're certain is not a long-run sustainable price. So we see a lot of upside without any positive changes in fundamentals. It's just to meet the needs of the existing reactors. And incidentally, China's building reactors a lot faster than the plans for Germany or other countries to shut reactors down. So there should be growth as well, but that doesn't even need to happen.
You also like dams, I've heard.
Yeah, the dam business, huh? But it's, we also like the fact that we think whatever change is happening to the world, electricity is not one of those things that's threatened. People will still want air conditioning, they'll still want heating, and they may even want it to run their cars increasingly. And then the electricity that's preferable is the electricity that's cheapest, that's cleanest, that doesn't have the CO2 footprints and doesn't have the pollution. So hydroelectric power, it's a wonderful source of cheap, clean electricity. And there's only so many places you can build dams. There's not that many rivers that you can do that with. And once you've done it, you can't really put another one anywhere nearby. So you have a monopoly of cheap, clean power. If it costs $2,500 to build something per kilowatt of capacity, theoretically, the market should value that at least that price, maybe at higher prices. But because people are afraid of emerging markets right now, if we go to Brazil and Russia and places like that, we can buy things at 2/3 off. Once again, if we're patient, there's a chance of doubling or even tripling our money. So we very much like cheap, clean power that's trading way below the price of replacement.
And how do you find good companies and good capital allocators in this sectors like uranium, gold, or hydro energy?
Well, one of the knocks with gold is that they're notoriously bad at capital allocation, but we do different things. One, we try to buy it way too cheap. So even if management makes a few mistakes, we're likely to be okay. But we also buy some of the better management teams, and we buy the largest resources, and we diversify. We diversify against different management teams, different countries, different chemical, different geology, you name it. So that helps. I think with the uranium, they have allocated the capital a lot better, although they're far from perfect, they're better. The utility space, whether it's the hydroelectric dams you mentioned or nuclear power in France, we've owned that, and we've owned other utilities. They're not tremendous capital allocators. They tend to be run with a lot of government initiatives. So in France, they're forced to underprice electricity to make the customer happy. In Korea, they're forced to underprice it to make industry happy. In Brazil, they were forced to lose money, and now they're not, so the stock's gone up quite a bit. In Russia, they're allowed to make a pretty good return, but then they're forced to raise capital at inappropriate prices and to build dams. So it's always, we get this and we have to give that much back through politics, but we're paying a small amount. So even after all the problems, we're getting, we think, good return prospects, very good return prospects.
Can you name some good and interesting companies in the fields?
Good.
Interesting companies for you.
In that field? Or?
Yeah, in uranium and gold, for instance.
Oh, certainly. Uranium, the two biggest in the world are Cameco. It's a Canadian company, used to be owned by the Canadian government. And they're pretty diversified. They have some of the best mines in the world. Well run, we think. And Kazatomprom, which was also owned by the government of, they've just recently sold off some of that. Kazakhstan still owns a lot of it. But now they're the biggest in the world now. And so they've increased a lot of supply. They're very profitable. They make a lot of money. So those are the two that most people would get comfortable with. And then there's companies that have good prospects, but they don't have mines yet. NextGen is a company whose stocks become very, very cheap. They don't have a resource yet, a reserve yet. They have resources of maybe 300 million pounds, which is theoretically worth many, many, many times above the stock price. Another one is Fission, which is located right next to NextGen, also huge optionality to the upside. Yeah, so the gold industry, we have a sort of two-pronged process. We own arguably the best company in the business. It's named Newcrest. It's in Australia. One of the other participants talked about it today. But it's one of the largest. It's got great mines in Australia and in Papua New Guinea. It's got 3 to 4 decades worth of reserve. Now, gold, it's both a good and a bad thing that people aren't making it anymore. They're not finding it anymore. It's hard to find. So owning the reserves is a very positive thing. So they own a lot of gold, and they've actually allocated capital pretty well. So we're impressed with management, and we're impressed with the reserves. So that's sort of an anchor holding. We used to own a couple of the other big ones, but more recently we've found some great opportunities in companies that are small, but they own big, big reserves. In Alaska, we have NovaGold, we have Northern Dynasty, both that don't have mines running yet, but they have massive amounts of gold, or theoretically worth way more than they're selling it. We have Seabridge in Canada that's very similar, massive amounts of gold, no mine yet. And we've got a hodgepodge of other companies around the world, and so some downside, massive upside if things go as we expect they might.
Thank you very much for the first part of our interview. I'm looking forward to the second part where we discuss your global focus. Thank you.
All right, thank you.